Good morning, everybody. It's Trent Klarenbach with Klarenbach Research. Today is August the 28th, 2024, and today is a big day in the market with NVIDIA reporting after the market close. So there's a lot of anticipation that there will be a strong positive reaction to the earnings report, which will maybe drive NVIDIA stock higher and also likely the stock market in its entirety or in its overall stock market. Now, that's very well possible, but if everybody is thinking that's going to happen, maybe we should start looking for reasons for that not to be true, or maybe prepare us for the inverse, maybe prepare us for a pullback. So when I look at the S&P 500 index, I'm looking at the monthly chart here. And what I did is here, I got these numbers above and below these candlesticks, and what they represent is a sequential number indicator. Now, when you look at these number indicators, when it gets to be like a green 8 or green 9, you anticipate the market to start to slow down, and perhaps we see a pullback. So when you get a green 9, for example, now this isn't a really bearish green 9, but you start to anticipate a 1 to 4 period pullback, and in this case, being the monthly chart, a 1 to 4 month pullback. Now, again, this isn't a super strong bearish green 9. In fact, it might be a bullish green 9. It could be it's a bullish candle by most measurements. I do my what I did is I draw a Fibonacci retracement tool here, and I use it from the January 22 high and the October 22 low, and we're sitting at that. The candle is right at that 1.618 fib level, which is often an area where sellers come in and the market gets retraced. And combination with the green 9, okay, we had two indicators that we start to have some belief that we could get a pullback. If I look at the RSI, I like looking at the RSI too. I don't talk about the RSI often, but I will in this situation. So what I look for is divergence between the RSI and the stock or the market. In this case here, we're seeing a series of higher highs in the S&P 500 index. At the same time, we're seeing a series of lower highs in the RSI in the monthly chart dating back to 2018. So when I see bearish divergence between the price and the RSI, and I see 3 points, my conviction strengthens that we are nearing the end of the move, and we're going to have a local top and a pullback. So I'm looking at that, considering that, and being aware that, and preparing myself for a pullback in the market. Now, how much that pullback can go? Well, often the pullbacks come back and test the previous breakout highs. So that was back in December 21 or January 22, I guess it was. And, that's a 14% pullback from today's level. So not suggesting it's going to happen, but be prepared for it to happen. If it doesn't happen, if it starts pulling back, don't be surprised, right? So let's look at the weekly chart. The weekly charts, again, we see a few more lines on it here, and we see some divergence again, too, with the RSI. The MACD down here, this is what I consider to be a bearish pattern on the MACD. Now, the fast line is below the slow line, and it's starting to curl under. So it just gives me conviction that we can see a pullback from here. Does it have to happen? It certainly does not. But if it does happen, where's the capital going to go to? Now, I happen to think it'll go into grains and oilseeds, but it's not all going to go into grains and oilseeds. We look at the US dollar index here, the Dixie. What happens is there's been a negative correlation between the US dollar and the stock market to a point where the US dollar is considered a low risk asset, and it's a risk off asset, I guess you might say. So if the dollar rises, the idea is the stock market will go down and vice versa. So right now we saw a pullback in the Dixie index here. Started in June, I guess. And now we're back down testing this purple 200-week moving average. Now, these moving averages often bring in sellers or bring in buyers and bring in sellers. So you can see back here where the 200-week moving average acted as support, did here throughout from 19 until it broke. And once it regained the 200-week moving average, we saw, a retest of it and then a rally in the Dixie. So if the market pulls back, I think commodities, US dollar is going to see some action. And I also think there's a potential for bonds too as a low risk asset. So this is the 20-year treasuries measured against the S&P 500. And you can see here that, you know, bonds have been a horrible investment relative to this S&P 500. So, but that might be changing. This green line is the 50-day moving average. Now, trend changes will happen on the lower terms before they happen on the longer terms for obvious reasons. So this is the daily chart. Now we're seeing this 50-day moving average rise, and we're finding some consolidation above it. We saw a breakout of the long-term trend line and the 200-day moving average. We don't anticipate that line to get broke or that moving average to get broke and stay above it on the first try. So perhaps we're winding up for another test of that 200-day moving average. There's some signs that the stock market could pull back, and there's some signs that we could see strengthening, a reallocation of capital into, I believe, grains and oilseeds, but also the US dollar and bonds. My name is Trent Klarenbach. It's supposed to rain in Saskatoon this afternoon. Life's good.